Welcome to another live monthly webinar series. I'm one of your hosts, Megan Anderson, along with Barry Habib. And today's special guest, she has more than 20 years of experience on Wall Street. She's currently the founding and managing partner of Fairlead Strategies, an independent research firm and investment advisor focused on technical analysis. She's a portfolio manager for the EFT TAC. She's worked with BTIG, MKM, Morgan Stanley, and with Soundview. And she's an official CNBC contributor. In fact, you probably saw her on this morning. Join me in welcoming Katie Stockton.
Hey, Katie.
Thank you, Megan. Hi, Barry.
How are you? It's so good to see you.
I'm great. I'm great. Nice to see you guys too.
So, Katie, there's a lot of movement in the marketplace, certainly on the stock side. So I think that a lot of people that are on this webinar with us right now, we've got close to 1,000 people on already. And what we want to make sure we do is address some of the fears that people have, both in interest rates, and let's see where we think they're going. And as a proxy, we could easily use the 10-year, but also there's a lot of people that have money invested in the stock market. And we can take a quick peek at some of the indices. If you'd like to even start there, we're going to leave it to you. What is it that you're most wanting to talk about as we begin today?
Well, I mean, there's a lot of technicians getting very vocal in this environment because obviously we're trying to recover from what was a very difficult 2022, and bear market cycles are actually where I think technical analysis is really gets a huge following, right? Because people are looking for answers. You know, it just doesn't make sense at times why things are happening. Maybe it's macro, maybe it's political, maybe it's fundamental, but the charts can help us sort of take some of the emotions out of it and I guess discern whether we're on the right or wrong side of the tape at any given time. So that's our goal, is to try to understand not where the S&P 500 is necessarily going to be at year end. We don't have that crystal ball, but rather to help folks manage risk by being on the right side of the market when the market is trending one way or the other. So we spent most of 2022 quite bearish, and that was, of course, a departure from preceding years. So that was a shift in what our work was. But now we are contending with, a pretty strong relief rally in the major indices. And I'd say a lot of technicians are out there saying, okay, well, we have a bullish reversal. Where we're differentiated from that is that we have a model. It's called the cloud model. I can show it to you if you don't mind a screen share here. This cloud model suggests that we're still in the bear market cycle. And so this is a prevailing sort of trend following gauge that we're using. And when we use it on the weekly chart, this is the S&P 500 index. You can see the cloud, or sort of shaded area there, suggests that there's still very good resistance. And it also suggests that the bear market cycle will keep its hold into the sort of last quarter of this year based on its trajectory. So if you were more traditional, I'd say, not using this model, you would say, well, we have a reversal because a trend line has been exceeded. So perhaps people are drawing it here and saying, well, this is a bullish reversal, but you can see how the cloud is suggesting otherwise. So we want to be respectful of our methodology, especially at this sort of trying time for the markets. And at least, we can have conviction that from a short-term perspective, there is some risk. And we see it, in fact, on the same chart with this model called the stochastics. And this downturn, it essentially means we have an overbought downturn still within the context of that bear market cycle.
So, Katie, let's break this down so everybody that's watching can completely understand what we're talking about. So, Katie, if you don't mind, let's show that September low at roughly 3,500 on the S&P. Mm-hmm. So if you want to just highlight that area there. And as you can see, we've been in a rally mode from that 3,500 all the way up to over 4,000. And, so funny, I think it was right then when Jim Cramer said, oh, now we're in a bull market and we're going to be, so his timing might be uncanny. But since then, the market's gone the other way. So that's what Katie's talking about. Katie's talking about, okay, we broke through that trend line. And some people looked at that as, hey, it's the all clear signal. But what Katie's saying is, hold on a second. You see the blue shaded area that is providing overhead resistance. And she feels, correctly so right now, that the market would reach some exhaustion And as you can see, it's confirmed underneath in the stochastic chart where we have reached overbought levels. Now, overbought can remain overbought for a long period of time. You can see it to the left. If you go to 2021, we're overbought for extended periods of time, but also it's been very indicative. Take a look at previous to this rollover where you see the stochastic cross, you see the red line crossing below the blue line on the underneath chart. If you take a look at what happened the previous couple of times, you saw the market respond with a bit of a decline. And those are pretty pronounced declines that you've seen in the marketplace. I mean, going from roughly 4,100 to 3,500, that's 14% drop in the marketplace right there, just doing the math in my head. But you could see that these stochastic moves can be very indicative, especially when accompanied by overhead resistance. The past two happen a trend line, but this one's happening at the cloud. And if we break under the trend, Katie, would you say the next stop would be probably at 3,500?
Yeah, so we're actually looking at the initial support as being very close to in line based on not that same weekly chart, but the same model on this daily chart. So if you see, to the extent that the S&P 500 is below that cloud on the weekly, you can see it's above the cloud on the daily. So this cloud is now sort of framing the relief rally that we've seen, which has been about 20% off of that October low. Don't want to minimize the significance of that. With this pullback, it's kind of come into that support level based on the daily cloud. We're putting it just about 3,900 to 3,925. You can also see this purple line, that's the 200-day moving average, pretty well aligned with that same trend line we just drew. So pretty key near-term support, roughly 3,900. A break below that then for us puts the next key support in that 3,500 zone. So I certainly would not rule that out as part of what could be and what we hope to be a bottoming process, with the emphasis being on process. That bottoming after a bear market cycle, it doesn't usually culminate in like a V bottom fashion. Usually you see a series of retests of support. So maybe that's the 3,500 level. And that's when you start to see accumulation in the indicators behind the scenes. And that becomes the stuff of a more lasting market bottom. And we do think that there will be a market bottom this year. And that's based in part, and we can zoom out even further here on the monthly SPX chart. You can see that while we have a cyclical bear trend still in force, that this is the secular bull trend. So this is going back about over a decade. And so the monthly cloud would suggest that we indeed would be well served to kind of be out there ready to add exposure when the market tells us that it's done going down.
So longer term, we know that stock market has a bullish bias, right, over the long term, as the economy grows and as people have more money. And so we understand that. And this is certainly very indicative here. But I think if you're listening, and what we're trying to kind of come up with a game plan, if you're listening now, certainly looking at this chart, long term should be okay, right? Long term, depending on what we're talking about here, but certainly if measured in years, you should be okay. No reason to panic. But if you're looking to trade this, I think what, and please tell me if we're interpreting this correctly, is let's wait and see that 200-day moving average. If it's convincingly violated to the downside, that means that if you want to trade it protectively, then stay on the sidelines, because probably 3,500 is likely. But if you want to be aggressively trading it, then maybe put some positions that would take advantage of that downside move, some short positions or put positions that would take advantage of that move. But don't do that until we see if that 200-day moving average does indeed hold or gives way.
I think that's a fair way to play it. I think we want to make sure that we have the most probabilities on our side. That's what we're trying to do with all of these indicators and levels that we're keeping an eye on. So I think if you were to have no exposure right now, you might want to take that short position, or consider some inverse ETFs or something of that nature. If you do see the breach of 3,900, that's decisive, and that's part and parcel with this, which shows negative long-term momentum still having a hold on the market. But then on the backside of that, we want to look for for indications of support discovery, even irrespective of what level that occurs at. We want to make sure that we see some successful retests of a certain level. And that would be something that would not only give us a little bit more confidence that the market is bottoming, but would also show some improvement in these longer term indicators, which just still aren't quite there yet from a technical perspective in triggering sort of a long-term entry point. We believe in market timing as a technician. So I think it used to have sort of a negative connotation, but to us, why wouldn't you? Just try to put the long-term trend following gauges at a very minimum on your side, because then by avoiding those big drawdowns, at least to some degree, nobody's going to time it perfectly, but to avoid them to some degree, you just put yourself at a better place, coming out of it, and also just with attention to capital preservation.
That's really important. What Katie's saying here is, when she's referring to drawdowns, those big downward moves. So if you can sidestep them by either putting hedged positions like puts that would offset your losses in long positions, or if you just sit it out on the sidelines and you're able to sidestep the big downside moves, it's amazing what it does to your returns. You see all these statistics out there. If you miss the 5 worst days or you miss the 5 best days, you can really see the returns change dramatically. Very hard to do, not easy to do. Katie does a great job of looking at these things. But at least me personally, when I start to look at some of the fundamentals, I think that, and historical moves, it seems like to me there is probably a very good chance that 3,500 gets retested. So, there's going to be upside moves in between, but I don't think that one test at 3,500 is going to be a one and done. I think that's, and as you said earlier, it's typically not a V bottom.
And I think that's, when we talk about the retest, if you think about how that would look on a chart, it would be somewhat of a trading range, right? Sort of a channeling type of situation with a lot of, unfortunately, short-term volatility in both directions, which is a really difficult environment to navigate. So sometimes you just are well served by being less exposed. You can just sort of reduce your exposure, or you can be more active and short-term oriented and try to trade those shorter term moves. But the point on the trading range and that kind of setup, I think it's more than just equities, and just to kind of bring us to the conversation about treasury yields and other macro forces. I think that this is a year that's probably going to see ranges develop in a lot of sort of macro technical inputs, and that it would include yields.
Katie, is there a specific stock, or is there a specific sector that you're seeing that is giving you some very clear signals as to what is a likely move or a highly probable move? Is there a breakdown that you're seeing that's in somewhat of the early stages that would lead us to believe that there's some momentum there? Or is there an upside move that may be counter trend to the overall market, but that really seems that there's some strength there that has legs?
Yeah, we do a lot of sector work. We focus oftentimes on the relative sort of status of the sectors to determine which ones we want to be overweight and underweight. And I'll show you at first sort of the good news. And this would be based on the sectors in the S&P 500. If we were to look at this here, let me find, okay, this is good. Okay, so on this, we have the S&P 500 sectors. And I want to show you this rotational graph on a 6-month view because it's a long-term picture. And let me make this bigger. So if you see that this shows the trailing history of each of the S&P 500 sectors and then where they stand at present. And each of these sectors has, the trailing history will show, has it been outperforming? And if so, is it doing so with more or less momentum? The ideal setup is something that's pointing up and to the right. So the only thing right now doing that is industrials. So you can see industrials here. Industrials being close to the crosshairs means that it's been performing close to in line with the S&P 500. So to be honest, this isn't a very exciting setup. But what the whole thing is showing is that while we've had utilities, healthcare, consumer staples, and then of course energy way off to the right here, those have been our sources of outperformance of late. And that of course shows a more defensive type of posture to the market. Folks are seeking out positions that they feel like are safer. But notice the rotation. Now this, if we were to animate this, you'd actually see it maintains a clockwise rotation. look at what's sort of bringing up the left side of the chart. It would be communication services, consumer discretionary, and technology. And that paints a more bullish picture if you think about it, because it would be more offensive positioning. So if you can imagine what this chart might look like in 6 months from now, I think we'll probably be seeing a bit more offensive sector positioning. But in the meantime, we still have really the last man standing in terms of sector sort of uptrends would be energy. And then these, the more defensive sectors, they're more trading range bound, but you can see they all have lost that sort of momentum behind their relative position. And I think that's a really interesting longer term takeaway from the sector rotations that we're seeing out there. So to the point of the energy sector being kind of the one that is still in a long-term uptrend, I'll show you on the monthly chart. Here's your long-term uptrend. This is, you can even see it just in that 12-month moving average. But notice there's that downturn. That's that same stochastic downturn. We don't love to see that, and a little downtick in momentum. So that downtick has manifested itself in a subtle loss of relative strength. So we suspect that energy is not going to be the source of outperformance that it was over the last 2 years. I mean, it was really very explosive, that dispersion too, with other sectors. It'll probably move down in the ranks a little bit, but it is the last sector that's still in an uptrend. We also have on this chart, I think this is fascinating, the DeMark indicators. And these are indicators that will show if something is more overbought or oversold. And it's when you see a 13 pop up, and I won't go into the nuances of the indicators because it's just too much for this call, but the 13 suggests that there's a trend exhaustion sort of underway also in energy. So energy for now, it'd be in our ETF, which is called the Fairlead Tactical Sector ETF, or TACK, TAC. The energy sector is the only sector exposure that we still have. And I suspect that we will kick it out, and move to a fully risk-off position before sort of pressing reset and getting back to the, more offensive sector exposure.
And then what are the major components within the energy sector that you have? Like what are the underlying weights, or what are some of the most heavily weighted things that are in that energy sector?
Yeah, so what we're doing is we're actually sort of trading the ETFs ourselves. So we have exposure to the energy sector SPDR, which is an S&P 500 fund. And you see here the components, very heavy Exxon and Chevron. So it's really sort of a cap-weighted exposure to S&P 500 energy names. Our hope with that, by being more top-down in our orientation and our technical model that serves as the basis for tech, that we're capturing, the large caps, the ones that the market is rewarding as having the best fundamental sort of status, right? So we're kind of putting some trust in the market to reward the best fundamental companies and allow them to be the most highly represented in these sector ETFs that we're trading. But otherwise, as mentioned, it's a very sort of risk-off position that we're holding outside of energy. And energy is only about 12.5% of the portfolio in our model, so it still has a relatively small footprint. It's much heavier in exposure to short-term treasuries, long-term treasuries, and gold right now.
So what are some of before we get to gold, short-term and long-term treasuries, which, the yields on those have really become, I think, attractive for people to buy. So what's the cure for higher rates? It's higher rates, right? So when we take a look at some of the areas that might be breaking down, is there anything that stands out to you, either a stock or a sector that we should avoid?
In terms of breakdowns, we've already seen some breakdowns give way to downtrends, right? So I would actually highlight, go back to the more offensive sectors of the markets. Those have done the most poorly throughout the bear market cycle. And you can really see that. I'll show you just an example of the technology sector versus the broader market. So this is the XLK ETF divided by the S&P 500. And you can see that for most of 2022, it was underperforming. And with this, really in the earlier stages of the bear market cycle, we saw a lot of breakdowns. The breakdowns are, I'd say now, sort of fewer and farther between. We're not seeing a whole lot of new breakdowns, but we are seeing downtrends, just now, of course, giving way in some places to relief rallies. I did come across one big breakdown today, and this is something that just kind of I would flag. This is Electronic Arts, or EA. And, it would be probably in the discretionary sector, but look at this move. So we don't want to see stocks come below this monthly cloud-based support level. And this is one that just, sort of got flagged in our work as having a pretty major breakdown. So to the extent that we're seeing this type of action, that of course is a setback, but it's a setback that's more, specific to the stock in question, as opposed to any big sector breakdowns. We do trust that when the market comes out of this cycle, that we will actually get greater interest, probably in the same names that outperformed in January. In January, we saw this massive sort of surge in sentiment. I don't know if you follow things like the Fear and Greed Index or
Very much so.
Yeah. So it really was pretty explosive, and investors just gravitated right back to the mega caps. For one, Tesla, I think, is probably the best example of that. They gravitated to sort of small mid-cap tech, sort of the software space, and that was an area that had been downtrending for much longer, but also I think the stories really appealed to investors, and even Bitcoin and meme stocks. So it was really pretty far down what I would consider to be like a risk spectrum that folks were sourcing for relative performance.
Well, what's interesting about this EA stock that you bring up, when you look back 10 years ago, when it actually broke above the cloud resistance that it had, it sure went on a heck of a run. Mm-hmm. So, and then it tested the cloud for support. And now the breakdown is something that we haven't seen. We haven't seen a move in 10 years where it's broken beneath cloud support. So, it could be just testing the bottom of the cloud, right? But
that's right. It's not confirmed yet. We always wait for, I would say, at least a couple of weeks below a very long-term level to confirm a breakdown.
But if it does, it appears that there could be some downside momentum that will follow, right?
Yeah, I think that's safe to say. And to the extent that we have negative catalysts like this, and these negative catalysts can look like breakdowns. I mean, we had an intermediate term breakdown in Pfizer. It's quite oversold short term. But to the extent that we see these types of negative catalysts, unfortunately, it just prolongs the process, in our opinion. It makes it just, more difficult for the market to come out of this bear market cycle. So we're very respectful of any kind of negative catalyst like that we see, whether it's a breakdown or something like a sell signal in one of the indicators, like the MACD indicator, which is a trend following gauge. What's nice about these indicators is they have like a binary takeaway. So it's either buy or sell, no in between. So we can scan the markets for these sell signals.
Could you, because I see some questions coming up too, is there a brief way to give, in your view, some sort of an explanation to people on the cloud?
The cloud, yeah, sure. So the cloud, if you think about it, or any sort of trend following gauge, they're often based on moving averages of price, right? So a moving average, just like the ones you see here, are kind of designed to smooth out the trend and give you a good, clean picture of the directional bias over that time frame. So on this one, let me actually go to a more short-term picture here. So here's Pfizer. You see the purple line, that's the 200-day. You can see the 200-day is sloped lower. The 50-day in green is also sloped lower. So what that tells you is that there's a long-term downtrend and an intermediate-term downtrend. The cloud's design is really the same way, but it has an added dimension that it also can be a good gauge of support and resistance in certain environments. There's always that caveat of in certain environments, right? If something's in an environment that's range bound, well, any kind of trend following gauge would be a little bit less helpful in that sort of mode. But when you see price below the cloud, like here, this is when you have a downtrend at hand. When price is above the cloud, that's an uptrend over whatever time frame that you're reviewing. And obviously breakdowns would be catalysts that are negative, and breakouts would be catalysts that are positive. And the construction of the cloud is not based on moving averages, but rather midpoints of price. So we're looking over history, and we're taking a certain period and taking the actual midpoint between the high and low price of that period and projecting it forward. So you see how it has this little kind of plateau to it, jagged look to it. And the design of that is to show you where there might be prospective support or resistance, support being a potential area of buying pressure and resistance being a potential area of selling pressure.
Awesome. Awesome. All right. So let's talk a little bit about some of those other areas that people are looking at. Maybe gold is that a place to be is, and then let's take a look at maybe some short and long-term bonds. Obviously we're very, or short-term treasuries, we're very, of course, sensitive to that area of things. But I think the short-term treasuries offering such yield are now giving investors an alternative, right, of where you can put your money other than just equities, right? And of course,
that's right. The death of there is no alternative, right? I keep reading about that, and it makes sense. It just gives more options to investors. And I think in a way that's welcome. And you know, a lot of us are, like myself, are quite conservative and appreciative of being able to get some return in instruments that are just safer than equities. And yet, you know, that there can be limited upside too. So this is a long-term chart of gold based on the generic futures. And what we were happy to see with gold was that it came down in this sort of intermediate term downtrend that characterized much of 2022. It came down and held within that same cloud. So it discovered support where it sort of needed to discover support to suggest that this range that had been in place for years was indeed an interruption in this uptrend as opposed to a reversal of it. So we believe that this trading range that still confines gold with resistance at 2063 is something that will ultimately resolve to the upside, meaning that we'll see new highs from gold. It doesn't happen necessarily anytime soon, but you can see that the momentum here, this is the MACD, is improving. It's not overbought from a long-term perspective. Shorter term, we're obviously working off some overbought excesses, but the longer term setup is quite appealing for gold, especially if it can break out above that 2063 resistance level. That would be a long-term positive catalyst for gold prices. But for now, we're still confined to this longer term range. What's interesting is that the range we think is also sort of developing for treasury yields, and then also the dollar in turn, both of which have certainly been in very well-established uptrends now. And I don't think anybody would argue against that. In fact, if you just look at this 10-year yield, you can see the slope of the 200-day moving average, reminding us of the prevailing long-term trend. We believe, and you know, this is something that I think we have general sort of buy-in on from our client base, is that we've seen a secular shift. So we think that this uptrend that we've seen, it marks a shift from the multi-decade downtrend channel that preceded it. But still within that context, you can have some major sort of counter trend action. So in the same way that we had during the downtrend in yields, the very long-term downtrend, you would have at times very significant counter trend moves. And this is over history. It goes way, way back, right? So to that same end, we would expect at times for yields to be going lower for a year, even 2 years at a time, but still within the context of that secular shift. The reason we think that a range is likely following this steep up move, well, one, it's a steep up move, so they do ultimately sort of lose some momentum. So there's that, but it's based largely in the DeMark signals. So that the same indicator that I showed you before has this 13, which means that the uptrend got tired at that October high from last year. This is in yields. and has given way to just a subtle downtick in long-term momentum. So that subtle downtick would tell us we probably can digest for a few more months as the market absorbs that excess that sort of came into place in October. So that's our framework, is that we're most likely to see.
Katie, bring that up again. I wanted to ask you something, because I could see like the cloud support level for it, and it oftentimes goes back to test cloud support. That's way down. I mean, I don't know that we'll get down to the areas where the cloud support would be around 2% or so, below 2%. But we're looking at some fundamental things, and we think that inflation will take some pressure off yields as inflation moves lower. We also think as we get to March 10th, the jobs number that we received in February will. We got that on February 3rd for the month of January. We thought that had some quirkiness to it, and we think we'll get a more indicative jobs report that will show less strength. So based upon that, it does appear that there is a lot of room in yield to potentially rally here.
Yeah, so in terms of, I wouldn't look at the cloud as like a magnet or some kind of like mean reverting indication, but it does tell you what the prevailing trend is, which we know is higher here. But you could see a counter trend move, even more prolonged than what our indicators are suggesting right now. And then maybe this becomes a floor looking out at early 2025 at 3%, something of that nature. So I wouldn't think of it as like something that the yields might gravitate towards, but it does give you a sense of where there might be forward-looking support. The cloud on the monthly is sometimes a bit too far to be helpful as support or resistance, but it does give us that general sense of the direction. So there's that. We also would use, of course, the weekly cloud to refine our views. And here you can see this is the weekly cloud pointing higher, but notice how it flattens out. So it tells you that this uptrend is likely to give way to more of a range bound environment with a floor, and you see the floor is down here closer to 3%. So, I'm not making the call that yields will go back to 3%, not yet, but that could very well prove to be sort of the bottom of the trading range environment that we're expecting. The short term, there's the 4% level is kind of looming, right? That's like this psychologically significant hurdle for 10-year yields. And if we were to see a move above that level, then the October high becomes what we consider to be the sort of top end of that range, which is around 434.
Yeah, we definitely see those two levels as ceilings, and the 4% one's important. Like I said, if we can get to just get that jobs report on the 10th of March to kind of take some of the pressure off. Right now that we're trading based upon and you could see the move that occurred. You could see that to the dates. February 3rd, was February 2nd was the bottom. February 3rd, we just moved up dramatically on a jobs report that we believe was, not exactly indicative. And then you see the inflation numbers that came out, which while going down was stubborn, but there were reasons for that that I don't think the market looks too deeply upon. So we think that there's turning points here temporarily in March and certainly one in May. But 3% is about what we've been thinking. And folks listening, 3% on the 10-year, we still believe that over the summertime, that's a realistic number, which would result in normal spreads for mortgages to be around 5% mortgage rates. That's where we're getting our targets from.
Interesting. Yeah. And I see that, it came into that February data, certainly more oversold than it is now, right? So if you just look at the stochastics, they were quite oversold here. So that suggests that it was more overdone on the downside. And now, of course, coming into this print, we're more overbought. So, perhaps that 4% level is more of a hurdle with that in mind. But
we are also approaching oversold conditions right now. Right? I mean, overbought conditions in yield, right? Overbought in yield.
Overbought in yield. That's exactly right.
Yep. Overbought in yield, which does, just like we were ripe on February 3rd, we could be ripe with the right circumstances on March 10th, March 14th, see an exacerbated move in yield to the downside, or at least the momentum beginning there.
The equity market would certainly like that. It might be something that, the 3,900 level is preserved with that in mind, with it being so close by. So that's what we'll be watching primarily is, the reaction from equities and whether, it looks meaningful in terms of support discovery. So, and again, that kind of also goes back to the technology sector and its outperformance in January, which of course was when yields were coming in, right? So the tech sector tends to, respond favorably to that.
And Megan, you want to open it up here maybe for some questions for people? By the way, Katie, while she starts doing that and starts looking at questions, if you have some questions, just pop them in the chat, or if you'd like Katie to pull up something to analyze for you. But Katie, the yields that we've seen on short-term securities, we touched upon it earlier that there are certainly alternatives, but even the 10-year, let's just take a yield of 4%. If even short-term, it does get to 3%. That's a very significant return, because not only do you get your 4% yield, but the price appreciation that you get, you'd be beating the market by 1%. For 10 years, that's like a 10% deal, but you'd have to discount it for present value. But it still could be a 12% or so rate of return. And I was reading a statistic from our friend David Rosenberg. More than 90% of the time, when the 10-year treasury is at 4%, you do get a positive rate of return over the next 12 months.
That's interesting. And I think when we, being somewhat US equity centric, when we think about exposure to treasuries, so this is SPTS, which is a short-term treasury ETF. It's the one that we hold in our TAC ETF. When we think about it, what we're trying to source them for is outperformance in a weaker equity market. So we're thinking of them more in relative terms than we are in absolutes, but you can see it. So this is SPTS divided by the S&P 500. Just look at the yellow line. That's the 200-day moving average, and look at the curvature. So the 200-day really saw a turn, which means that relative performance for treasuries versus equities has really improved. And we're starting to see that on the long-term benchmarks as well. So I think it's something that again goes back to that there is an alternative now, and that there are some promising returns and some redeeming qualities of the safety that comes with them.
Yeah, Megan.
Yes, there are a few that people want to look at, one being oil.
Yeah, oil's been interesting. I feel like with energy, of course, maintaining that uptrend, it's almost remarkable that the energy sector has held up so well in light of what was a pretty sizable down move in crude oil prices. The down move has now given way to, I would call it a loss of downside momentum. So with this decline, so we saw this is the crude oil from early 22, this downtrend, you see the impact here on the stochastics, that's giving way to just a loss of downside momentum. So I suspect that somewhat like the dollar yields and equities, that crude oil and some of these commodities are also getting into trading range environments. So within this kind of cycle, we now have a loss of downside momentum. So our bias is for crude oil prices to rally, even potentially into the 200-day moving average, which I think is roughly 90. I'm not sure where it is right at this moment. But here it is, the purple line. So just about $90 per barrel. We would not be terribly surprised to see crude oil make some near-term progress towards that level as a resistance area. And we would see that as sort of the start or not necessarily start, but sort of continuation of a potential range. The support is shorter term, I would say, kind of like low 70s, maybe 72, 73. And then there's a longer term level around 70, which we're seeing as the floor to that trading range cycle. So more of a neutral long-term bias right now, but within that context, the loss of downside momentum would support a relief rally.
What about the China's reopening and the demand on oil from that? Is that something that's contemplated in some of this?
We don't ever think about why something's happening. Well, not ever think about it, but the charts won't tell you, right? So the charts won't give you that information. They'll tell you what's happening. They just won't tell you why it's happening, but you can kind of see, right? This is the KWEB ETF, so a China technology benchmark. You can see this really significant up move off the low, right? And that's likely, part and parcel with the China reopening trade. So with this up move, I think that it's pretty meaningful, actually, from a long-term perspective. The rotations that we have seen into China from sort of, the big picture would suggest that this phase of outperformance that we've seen is maybe the start of even a longer term basing phase. China, just like many other markets, is not out of the woods yet. You see the cloud acting as resistance for KWEB. But if you can see this, it just has this feel that it's losing long-term downside momentum. So I think that turnaround is meaningful. And perhaps that is, something that helps keep the floor under crude oil prices in that 70 area. 70 seems to be a number that's floating around irrespective of the charts.
Megan, there might be a couple of other questions. I see ones on MBS somewhere, and we could pull up a chart and let Katie kind of take a peek at that. But go ahead first, and we'll do that.
Well, first off, oil, that's exactly what I wanted to hear. So thank you for that. Another one that has been brought up by quite a few people is Tesla.
Right. And so I was all ready to talk about Tesla this morning on CNBC, and they didn't get to it. So it's very fresh in my mind. And it's probably the stock that I still get the most questions about. But because I have the audience here and I can actually show you something, I think this is fascinating for Tesla. This is a monthly bar chart. Here was a sell signal on that 13. That was a DeMark indicator. And look, this is a proper sort of bear market cycle for it, but look at where it came and held. It held actually near that cloud-based support on a very long-term basis. I thought it would break. It has not broken yet, not decisively. And now the cloud, you see it's getting thicker, and therein might be a little bit stronger as a level. So I do think there's short-term downside risk for Tesla. It has sell signals on the daily chart below the downtrending 200-day. But this 156 area as initial support, albeit about 25% below, that support level is very significant. So if we can see Tesla come in towards that area and hold, I think that would be something that would hold some promise. I think it's still too early, but I would say that this 156 level is going to be really interesting to watch.
Okay. And Barry, I don't know if you're ready to pull up the charts yet.
Yeah,
of course. Oh, you are ready? Okay.
Of course. Of course, we can do that. We could take a quick peek at mortgage-backed securities, and I'm going to share my screen right now. And Katie, I'm sure that you could take a peek at the screen here. So this is mortgage-backed securities. I could clean up our versions of support and resistance so that you can kind of see a little bit more of a clearer picture. This does have Fibonacci levels that we've drawn. Yeah. And it does have moving averages. I could take away anything you like to make it easier, and I'll give you a little bit of a further view. This is like a 6-month view, or 1-year view, whatever you want to take a peek at. We'd love to hear your thoughts.
Yeah, I mean, first of all, Barry, I love your charts. I think, you've got just a really unique perspective here with the Fibonacci's, which I really believe in. But also the candles. The candles are something that I don't use a whole lot of, but only because when I publish my research, they take up too much space. so I think it's a really nice way to understand, especially with the green and red, is really the true sort of perspective of what's happening here. And what you see here, of course, is consolidation, right? So very short term, yeah, exactly that consolidation. And then the question is this going to yield a turnaround? Are we going to get sort of an oversold bounce, if you will, or are we going to get an extension? And I would say the stochastics here, and we use something similar. We use the 12 period. It looks like you have a 21 period, but the message should be pretty much the same, where you want to see, in order to position for that oversold bounce, what I would want to see is the stochastics come back above 20% as like a catalyst, right? Because that would suggest that the momentum is shifting. So as it stands, the momentum still to the downside here, short term, right? And you can see it took out the 61.8% retracement. So I would trust that this move is going to continue on the back of the consolidation. But with the sort of stochastics on our radar, I think we can at least try to sort of time, if we were so inclined, a re-entry here. But I would wait for those stochastics, and it's a really kind of cool feature of the stochastics. If you go back, in fact, to the time frame, it looks like between sort of mid-October, right, when yields were peaking. When you saw the stochastics come off of there, and also the December turnaround, you see how that waiting for the move above 20%, you were not too late, but it captured the major turnarounds. Back in October as well. There you go. So those are great catalysts to keep an eye out for.
So Katie, what we're looking at here is, it looks like, as you said, there's consolidation. It appears that it's trying to form a base right here, if it can, but it's being squeezed. From a fundamental standpoint, there's not a lot of news that's going to move this in the meanwhile. So we're just hoping that this holds on, because there appears to be some pretty significant room to the downside.
Yeah.
So we could move, significantly lower to the next Fibonacci level.
And it could happen quickly too, if you think about it, right? It could be sort of a news-driven move or a knee-jerk reaction. Sometimes you get that, and that's kind of just what it needs to kind of flesh it out a little bit, and then it ultimately holds.
Yes. Now, we think, again, fundamentally, March 10th, March 14th, we're going to get some news that does help mortgage-backed security pricing improve, 10-year treasuries improve, but nothing is a guarantee, right? This is just our best assumptions of what we're seeing out there. So should that occur, I think we could say, and you pointed out the last two stochastic crosses from oversold levels, especially off of levels of a floor, really springboarded it, and you could be in for a nice move higher, at least perhaps to retrace. I don't know if all the way up to the 200-day moving average, but perhaps up to maybe the 50-day moving average. Which
I mean, that 200-day has proven to be really important, and not just for MBS, but for so many instruments of late. And it just tells you that there's probably a whole lot of eyes on it. But I tell people that the stochastics in an environment like this, where we could have a range at hand, will be a great market timing device. So if you were, interested in short-term trading, it's just a great sort of way to improve your probabilities to have that stochastic oscillator pointing in favor of your position. And they're really sensitive, they're really attuned to those short-term moves if you're looking at them on a daily chart, especially, and even to some degree on a weekly chart. With the weekly stochastic, you're getting pretty good shelf life, I would say, for a trade, if you will. So, you're getting weeks out of it. And I think it would be a great tool in this environment.
Yeah, these were position locks that we had during the updates in the morning, but which were, before the market had actually moved. This was the day before the jobs report, and clearly driven by the 200-day moving average ceiling here, and the stochastic crossover you can see. So we avoided, in all three cases of late, some pretty significant moves. The other carrots, you see, those are intraday rate locks that we had, on the way down. But it's frustrating for people. They've watched this kind of melt away, and there's clearly risk to the downside, but you don't want to pull the trigger too early, because we could just be, we're like a spring that's wound. You lock down here, and then this just unwinds, and you get an explosive move to the upside. I mean, there's the potential for that, and it's going to be significant, because the current price is, let's call it 99.7. You could get up to 101. It's 130 basis points.
Yeah, that would be a huge move. And I also wouldn't rule it out. It is hard to, especially when you have the sort of challenge also of navigating all of this macro data, right? The market, I feel like, is continually having to absorb the data, not just the data, even just sort of Fed speak as well. So there's that kind of catalyst driven move at times, and you get the knee jerk reactions and, securities that should not have the level of day-to-day volatility that we are seeing at times here. So it's a really sort of challenging thing to trade short term. But just the more indicators that you can have on your side, right? Whether it's stochastics or even the MACD, that's just going to, help in this type of challenging, fickle tape.
We had a lot of questions come in about how to better understand these charts. And I just want to say a few things. First and foremost, I'm putting a link in the chat box right now. You can get a free trial of Katie's research. That will be a great place to start. Also, a lot of you are
you're crazy.
subscribers.
Hold on. You're crazy if you don't take the free trial to Katie's research. You will learn so much.
Crazy.
And Katie is a member of the faculty in CMA. So
I was just going to bring up CMA. She did a portion on CMA, and I'll be honest, where I started learning a lot of this kind of stuff, and I'm still learning. Thank you guys. But CMA was a major place where I started. It's our certified mortgage advisor course. It's basically Barry's brain. Katie's on there. We have Steve Nissen, so many amazing people that you can learn a lot about how to read these different candlestick charts. And and patterns. And I'll go ahead and put that link in the chat
Steve
box as
Nissen
well.
brought candlestick charts to the US. I mean, he's the guy that brought
the source and truly an expert. And I think it's great what you guys are doing with that in terms of overlaying technical analysis with sort of a discipline and the credentialing program. I just think it's something that every program should be doing, and they're not. So, you know, we have our own credential called the CMT, or Chartered Market Technician, and there's no mortgage piece in that. But I do think that, you know, to the extent that folks can now obviously source this kind of information through these channels, whether it's a CMA program, some kind of teach-in that we can offer them, or just there.
You do a lot of that, Katie. You do a lot. And by the way, before you go ahead and go to becomecma.com and sign up, why don't you just instead send Megan an email? And we'll for those that are on this call, Megan will come up with a special code and a huge discount, because it's important that you all do this right now. There's so much other than technical analysis. So Megan will do that. But make sure you sign up for Katie's free trial. And Katie, what about your ETF? That's what I wanted to ask you about too, because that's a great way to use the power of what you do. And instead of trying to do it ourselves, we could just turn it over to you on your ETF.
Yeah, and that's I think a great way to put it, in a way, Barry, in that we're trying to create with the ETF like a holistic portfolio driven by technical analysis, meaning that, you know, we don't really believe in a long-term buy and hold strategy, but this is an ETF that you can hold long-term. And because it has that dynamic nature to it, so it starts with the S&P 500 sectors, tries to find the ones that have the best long-term momentum and relative strength. And when the market's not lending itself to uptrends, like last year, it will move into a diversified portfolio of the risk-off categories, which we are considering short-term treasuries, long-term treasuries, and gold. And it's that diversified piece also that will save you in a year like last year, where it was also a long-term treasury bear market cycle as well. So, you know, we found something that we feel like provides safety when there are big drawdowns in the equity market, but then also has the ability to leverage the sector momentum and relative strength when the market is working and firing on all cylinders.
That can really be helpful, especially so that we don't have to watch it ourselves. It's very, very helpful. And once again, I just want to remind everybody, Megan, MEGAN at MBS Highway, and she will take care of a huge discount on CMA for you, because you attended this call, and it's a tough time right now for many of us. We have to be smarter and better at what we do as far as your own portfolio, your own money, creating wealth, managing your wealth. Katie was kind enough to give you a free trial to which I think you put in there, Megan.
I put the free trial link, and not only that, many of you have brought up crypto, and I know we are running out of time on this call.
Let's do a quick crypto.
We'll do a quick overview, but I also just want to say I'm putting another link in here where you guys can get her research report on
and it's all in the chat. So just click on chat and you'll see it in there. Megan's going to do it right now. There it is, Fairlead Strategies. That's the crypto sample request though, Megan?
Yeah.
Yes, I'm going to go put all three of them in now while you guys go over this. You guys will have all three links and directions in one chat box.
Thanks so much, Megan.
Okay. So keep your eye on the chat window, guys. And also, Katie, do you want to give a quick update on crypto?
Yeah, for sure. And listen, like it is something that still is very much on our radar. We publish on a weekly basis.
Well, one other thing, they keep asking for your ETF symbol, the ticker for your ETF.
Yeah, so TACK, TACK. So let me just show you on Bitcoin, because I think this is, sort of foundational to this space, but we do some altcoin work in our weekly report, which is very low priced. Just, to sort of maintain it even through the bear market cycle. But here's Bitcoin. I think it's really exciting if we were to see Bitcoin clear this resistance level. I'm going to take off some of my lines here. If it were to emerge from this trading range, that would be bullish. And it's like the first thing that we've been able to say in a long time that's remotely bullish on cryptocurrencies. But at this level, sort of this area or zone of resistance, if it were to be cleared, that would be a base breakout. So 25,200 is the level to watch in our work. for a breakout. Now, unfortunately, we don't think the breakout's going to be near term or is imminent, but it's something to keep on your radar. So in between now and then, until we ultimately do see some kind of breakout, we're going to just focus on the short term and navigating the swings and managing risk. So we do think the risk is a little bit greater to the downside short term, but at least we have a well-defined level to watch. And the other sort of last point I'd make, if I can find the chart here, on the monthly chart of Bitcoin, which might be hiding. Oh, I don't know if it's here anymore. But on the monthly chart, it looks a lot like Tesla, which is really kind of funny, right? But there's been sort of a correlation there because the retail investor is very interested in both Tesla and Bitcoin. And so just like Tesla has that monthly cloud essentially in play as support, so does Bitcoin. But what that makes very essential is that both manage to hold up pretty well in the near term. So a lot holds in the balance of the near term price action, which is something that we follow very closely.
Wonderful. Wonderful.
Well, I just want to say thank you both for your time and your expertise. Katie, I always learn so much from you when you get on here, and you teach me so much along with everyone on this call. I put all the links in the chat box for you guys. And yes, there will be a recording sent to you afterwards, along with all the links that we talked about today as well. So once again, thank you guys.
Yeah. And team, listen, I know that right now it's, things are more challenging. I just want to say something to you. Like, this is high level stuff. Some of you kind of watching this, and maybe it's a little bit hard to follow, but these are all learned behaviors. And we bring this up for you because it was a long time ago that I learned about technical analysis. And at first, of course, just like everybody else, it's a little fuzzier, but wow, has it made a difference for me, for my personal investing, for understanding the markets. It is absolutely one of the important things in a well-rounded way to become someone who manages their money, manages your own money, makes smart entry decisions, make smart exit decisions on the investments that we have. It plays an important role. And sometimes you hear me say it when we look at the charts. I mean, let's remember, they're never going to be perfect, right? And it's never going to be 100%. But it, as Katie said earlier, it really increases your odds dramatically. And that's how you win, by just increasing your chances dramatically. And these things will do that. I'm sure you've all been in positions where you say, okay, should I enter this investment? Should I exit this investment? Using tools like this and learning just a little bit more, each step by step, just like anything else, the more you learn, then you discover the more you need to know and the more you need to learn. We're learning. I'm sure Katie learns every day. I learn every day. Maggie just said we all learn every day. So I really commend you and admire what you're doing to try and just improve your knowledge base and just get better every day. We're all trying to do that together. We're just trying to bring this to you. I know it's high level, but you don't want to hear what everybody else already knows, right? This is something that is expanding our brain, expanding our mind, and taking us someplace that we don't normally go. So don't be hard on yourself if you don't get everything in the first shot. Just slowly but surely, step by step, watch the updates. We try and explain it to you, and write in if you have a question. We'll be there to help you too.
Thank you, everyone.
Thank you.
Katie, thank you so much. You're such a dear friend. We love you, Katie. Thank you.
Love you guys too. Thanks for the opportunity.
Thank you. Thanks, everybody.
Bye, everyone.
Bye.